Man, it feels good having the best quarterback in the league. Let me just tell you.
I know the feeling.
Why? Because Jim Kelly was pretty good for a while?
You could pretend like Josh Allen doesn't exist, but we all know better.
No one's pretending, but when I go to the stats and stuff, I look at top. I don't start like halfway in the top 10 or anything like that. That's not where I look.
Okay.
Hey everybody, JC Parets here, founder of AllStarCharts.com, and I am joined once again by my esteemed colleague, Mr. Sean McLaughlin. What's up, Shawnee?
What is happening, fella?
Oh, just back from a little hiatus. No big deal. Big deal?
No big deal, Just, bringing new boys into the world. No big deal.
They're good-looking boys, I'll tell you that much. I don't know where they got it from, but man, these are good-looking kids. Good-looking kids, and a lot of talk about babies and diapers and a lot of science. Whew, a lot of science. So
well, babies and diapers and all those expenses that might fall into today's trade a little bit. Consumer staples, maybe.
Nice little segue there. It's almost like you've done this before. So, Mr. Shawnee, I could not be more thrilled to not be talking about science and be talking about some stocks and making some money to pay for all these kids. We came into this morning's meeting. First of all, let's rewind. We had a meeting yesterday. We kind of wanted to let them dance, right? Let the market do its thing, shake things out. You really hate positioning ahead of events, regardless of what that might be, earnings, a big NFP, Federal Reserve, whatever big event is on the horizon, you like to avoid that. And I do too, right? Why are we going to set ourselves up for additional headaches? Life brings enough headaches. Why sign up for more?
Right.
So we all
normally
agreed.
We normally do this on Wednesdays, but as we were talking yesterday, we're like, there's this thing going on tomorrow afternoon or this afternoon, this Fed thing. A lot of jibber jabber about interest rates and the whole market's watching it.
Something you and I both pointed out with the quote unquote volatility throughout the day yesterday, Wednesday, post FOMC, the volatility index was flat on the day. The following day, today, down on the day, the volatility index, down a little bit. Just interesting, right? So I wanted to throw that out there. So I came into this morning's meeting. Our meeting was at 10 o'clock a.m. Eastern time. I came into this morning's meeting, thinking I want to sell some premium, right? It's a trade that continues to work, continues to pay. And I came into this meeting and literally before I said a word, you're like, so JC, I'm thinking we sell some premium. I'm like, that's my man right there.
Well, like you said, it's been working. In fact, this week we just took profits on two premium selling trades that we've done recently. We shorted puts in the banking ETF KBE as well as in CSX. Took profits in yesterday. And look, not every trade has worked, but the majority of them are working in this environment. So let's stick with what's working. And we're looking at around the world, or at least around the big ETFs, and seeing where's there still good premium. And right now the consumer staples was at the top of my list. And when we pulled up the chart and looked at that chart, we're like, hey, there's good potential here for some range bound activity, especially with that declining 200-day moving average starting to weigh on it, I think.
Oh, you touched on something real quick. You touched on the fact that we were selling puts, selling premium in financials and in industrials, right? You mentioned CSX, which is a railroad, which is in the industrial sector. Financials and industrials are two of the best performing sectors, right, in the market. Not necessarily energy, that's absolutely ripped and the premiums aren't as juicy as some of those other ones, right? So we haven't exactly been selling puts in energy, but in financials and industrials have been working. Another sector that is outperforming some of the other areas is consumer staples, which is the conversation that we're having now. Notice, Mr. Sean, we're not selling premium in communications. We're not selling premium in technology. We're not selling premiums in things that are the worst areas in the world because, and I don't want to speak on your behalf, but there's a little too risky for me. So I like the stuff that's working. Then when you look at something like consumer staples, by the way, this was your idea, and I happen to agree. So kudos to you on this one. you're like, I'm thinking we could sell a strangle in consumer staples, and I punch it up, and I wanted to see. I love a flat 200-day moving average, kind of messy market when we do this sort of thing. And well, here we are, flat 200-day moving average, messy market, and here we are doing that sort of thing. So let's walk through the actual trade. We're selling a strangle, the XLP 67.75. Short strangle means that we're naked short the 67 puts and an equal amount of the 75 calls.
Right. And selling those strikes gives us, at least at the time we put this trade on this morning, a $1.10 net credit, which doesn't sound like a lot, but hey, these are not home run trades, right? We're not trying to make our year by putting on a trade like this. We're looking for a high probability bet, and we're not even going to hold this thing all the way to expiration. Our goal is not to keep that entire 110 that we collected today. Generally speaking, my best practice with short strangles is I like to buy it back when I could buy it back for half of what I sold it for. So in this case, I sold it for 110 this morning. I'm looking to buy it back for about 55 cents. If I can do that over the next few weeks, I'll be very happy with that outcome.
55. I remember my first job. I was 17 years old working at a hot dog joint in Miami, just, a divey hot dog joint. And you had some codes. When a pretty girl would walk in, they would yell 55 coming in. 5 for 5 equals 10, right? So 55 coming in.
Ooh, us Chicago guys would call that a double nickel.
Oh, right. Double nickel. And then when we run out of dogs, they would say, put some more on, you moron. Silly hot dog jokes back in the day, hot dog jokes.
Hey, right, I appreciate a good hot dog joke.
Who doesn't? So here we are. Shorting strangles, December short strangle. Basically, we're betting that a messy market doing nothing continues to stay messy and do nothing.
Yeah, as long as we stay below 75, which we also agreed this morning when we were talking about this trade, we agreed that the risk felt riskier on the upside. Like if we were going to lose in this trade, we would lose on an upside breakout. So the 75 level. I mean, both levels we're gonna keep an eye on, right? Any close above 75 is our signal that we're wrong, we're gonna get out. Likely it'll be a loss in that situation, but depending on when it happens, it's possible we could still profit on the trade. But any close above 75 or below 67, which puts either of our options in the money, that's our signal to get out, close the trade, and move on to the next idea.
Something else that I was thinking about, during our meeting is when we're putting on these kind of trades, and this was your idea, right? My first question was, is it worth it? Are you getting enough juice, right? Like when you first said that, like in theory, it sounded like it made sense. My one hesitation until you pointed out that there's plenty of juice. That was my question. Is it even worth it?
Right. And generally speaking, and this is not true in every case, but generally speaking, when you're putting on a trade like this, you want to get, the premium that you collect up front, you want that to be worth at least 1% of the underlying value of the stock. So in this case, we'll call it a $71 stock. So if we got at least 71 cents, that feels like, it could be worthwhile. And we're obviously getting more than 71 cents. We got $1.10. So generally 1% is my absolute minimum floor, right? If I can't get at least 1% for putting that trade on, then I'm not interested. Because the way I see it is if I can make 1% in, 4 to 6 weeks, which is typically how long we have when we put on a short premium spread, 1%, 1.5% over 6 weeks, that compounds pretty nicely if you do that consistently throughout the year.
One lesson that I learned the hard way, and those of you who've been following me for a while know this, and those of you who know me well know this, is that when I was younger and less wise, not that I'm so wise now, but I was even less wise back then, I found myself buying stocks frequently that were near flat 200-day moving averages. And I noticed that rarely worked in my favor. All it would do is increase my headaches. So buying stocks near a flat 200-day moving average is not something I like to do. In fact, I always tell people, if you're near a flat 200-day, go somewhere else. Go do anything but buy that stock or ETF. In this case, we're taking my hard lessons early on in my investing career 20, 15 years ago, and we're flipping that on its head. We're taking advantage of people who still haven't learned that lesson and are buying stocks near flat 200-day moving averages, and we're selling premium against it. So talk about the evolution of a process.
Well, that's when you know you're a pro, when you take the lessons you've learned and flip them on their head and take the other side of the trades that you know all the other rookies are doing.
And there was somebody there taking advantage of my stupid mistakes back then. So nice to be on the other side of that. And it doesn't necessarily mean that we're going to be right, but this is one of those trades where it's not going to be a home run. It's not going to change our lives, but it is a very high probability that we are going to come out profitable in this endeavor. So it's a lower reward than swinging for the fences, right? Nothing wrong with base hits. Those add up, by the way. Ichiro Suzuki had a heck of a career, hitting singles and whatnot. And we can name a lot of other baseball players, and there's nothing wrong with that. But this is a very high probability. So keep that in mind. What we're doing is we're selling the XLP, Consumer Staples ETF, XLP 6775 short strangle for about $1.10 credit. That means we're naked short the 67 puts and an equal amount of the 75 calls for a net credit. So we got in at $1.10. If and when we are able to buy that back for 55 cents, we will, and we will take profits. And correct me if I'm wrong, Sean, if at any point the Consumer Staples ETF closes above 75, which are the calls that we're selling, or below 67, which are the puts that we're selling, at any point we get a close above 75 or below 67, all bets are off. We unwind our trade and we move on to the next one. I
could not have said that any better. Well done. The student becomes the master. Good job, JC.
Listen, I got my options chops, hanging out with you every day for years now. I used to know the basics, this and that, but the best practices I've learned through you. So I appreciate that, Shawnee. For those of you who have any questions on any of this, tweet Sean at Chicago Sean, reach me at All-Star Charts, or email us info@allstarcharts.com. We are selling a Consumer Staples XLP 6775 short strangle for about $1.10. We're naked short the 67 puts and an equal amount of the 75 calls for a net credit. And as always, I'm JC Parets, founder of All-Star Charts, and this is my boy John McLaughlin, Chicago Sean.
Take care, everybody. We'll talk to you next time.
See you next time.